All right, good morning. This is the meeting of the Retired Employees Healthcare Benefits Trust. We're in Bloomfield Township Hall, Thursday, October 31st, 2024, 7:30 a.m. Let's begin with the Pledge of Allegiance.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Okay. I am Treasurer Michael Shostak. I'm joined by Trustee Christopher Kolinsky and Finance Director Jason Tice. I note that all are present and accounted for. I'll open the floor for public comment. Seeing none, we'll close the floor for public comment. Next, we'll move to the minutes of the August 1st, 2024 meeting. They were in your packet. Are there any corrections or a motion to approve?
So moved.
Second.
Okay, we have a motion and a second. All those in favor of approval of the minutes, say aye.
Aye.
Aye. Those pass. Okay, those minutes will be approved as submitted. Next item on the agenda is our quarterly portfolio review. And we're joined here by Brian Green from Mariner Institutional to walk us through the portfolio.
Awesome. So, as I have in the past, I've always tried to come up with like a theme for what happened during the quarter. And the best one that I could come up with is what I have for you today is good news, not great news. Just in terms of kind of where performance came from and what went on. So, by every stretch of the imagination, it was a great quarter. Markets were in positive territory across the board. You know, the S&P for the quarter was up 5.9%. I'm on page 1 in the book. You know, mid-cap stocks were up 9%, small-cap stocks were up 9%. International markets, if you're talking developed, were up 7%. Emerging markets were actually the best performing asset class, or almost the best performing asset class, up 8.7%. So, you know, you name it, somewhere between 5 and 9% gains for the quarter across the board. The big surprise, I would say, is fixed income. You know, broad, high-quality U.S. fixed income was up 5% for the quarter, now up 4.5% for the year. So as we saw interest rates actually decline in the quarter, ahead of and anticipating what ended up being a 50 basis point rate cut, the fixed income markets rallied as interest rates fell, and stock market rallied as well, with the view of, hey, maybe the Fed did in fact get it right, and this is going to be no landing. Forget about a soft landing, but this is really no landing, and we're still off to the races. What is kind of interesting is listening to it. Spend so much time driving around. For me, a lot of my news and consumption comes in podcasts because it's just easy to load up my iPhone with them and have them play. And they're talking about. And Chris, this I think will hit home with you, is everybody's like, when's the third year going to come down from a mortgage standpoint, right? And like, well, if the Fed cuts by 50 basis points, then we should see a 50 basis point decline in the 30-year fixed. And that's not true, because the 30-year fixed mortgage is more in tune with like a 10-year treasury or a 30-year treasury. And the interesting thing was, and as I've talked to others, is from peak to kind of today, the 30-year has actually come down about 180 basis points, which is significant if you bought a home in November or December of last year, because you have some equity because home prices have appreciated, and you're now in the realm of it's a meaningful time to consider refinancing your mortgage, and would have a significant impact. From an overall performance standpoint, if you jump into page 3, as I'd mentioned, I have good news, not great news. The good news is the overall retiree healthcare trust for the quarter was up 5.88%. The not great news is the policy index is up 6.5%, so a little bit of underperformance for the quarter. So this is one of those scenarios where we come in and say, I'm sorry we didn't make as much money as we could during the quarter, but still pleased with some of the gains that we saw. Ancora up 8.9% for the quarter versus benchmark up 9.4%. Hard to complain about a 9% return. Their underperformance was due to an overweight to Microsoft and Qualcomm, which if you talk to David Sowerby, Qualcomm is referred to as the poor man's NVIDIA. just in terms of exposure to a lot from an AI standpoint. No surprises out of the Fidelity S&P 500 Index Fund. Edgewood, another disappointing quarter, up just shy of 0.4% versus their benchmark up 3.2%. It wasn't necessarily what they owned, more so as what they didn't. No Apple, no Microsoft, as both of those continued to drive returns higher. Clarkston will be at the FSC meeting at 8 to have a conversation. 7% return for the quarter. The interesting thing about Clarkston is if you would have said small cap stocks are going to be up 9% for the quarter, markets are going to broadly rally, we'd have said Clarkston's going to underperform, and should have underperformed significantly. Heavy quality bias in the portfolio. They have about 15% in cash just because markets have rallied and they aren't finding new names from their bench to add into the portfolio that meet their minimum return targets. So I will say I'm actually pleased that they're up 7% versus their benchmark up 8 and change. But the impact of what they had, from a performance earlier in the year, you see that 1 year number up 13.8 versus their benchmark up 26. What's wild is even though in the last year they're 13% behind their benchmark, in the last 3 years they're actually 1% ahead. So that tells you just how well, if you recall back in calendar year 22, when the S&P was down 20%, when fixed income was down 20%, when small cap stocks were down 20%, Clarkston was flat. So they outperformed by 20% that year, and that's still what's holding in that 3 year number to have them still ahead of the benchmark. Reinhardt, new addition. So the other piece that we did earlier in the year was diversified the small cap exposure. So it was a 50-50 combination of Clarkston and the Fidelity Extended Market Index Fund. It's now a third each. So diversified some of that exposure away from Clarkston. Reinhardt, great start. You see up 9 and change, a full percent ahead. Most of their performance was driven by U-Haul and all of their regional bank exposure. Names like Wintrust, First American, First Citizens. Oakmark, been struggling. Nice outperformers for the quarter. Deep value orientation. Outperformance for them came from, interestingly enough, their exposure to a couple of Chinese names, notably Alibaba Group. If you recall, I don't know if you're aware or not, but the Chinese government announced a pretty massive stimulus program late in September, and in a 4 or 5 day period, the Chinese stock market was up north of 20%. So huge rally there. Still seeing, as they've noted, a lot of narrow leadership. The international indexes have been driven either by the success or either by the appreciation or depreciation of ASML and Novo Nordisk. So semiconductors and semaglutides. From an emerging market standpoint, JP Morgan, you see up 4.5% versus their benchmark up 8.7. Cause of their underperformance was stock selection in China. They were underweight. And with that huge run up, weren't there to participate. And then finally, Baird on the fixed income side, no surprises. It's been a long time since I've said a fixed income portfolio was up 4% for a quarter. Or in the last year, I can tell you, I have to probably go back to an early point in my career when I can say in the last year, your fixed income portfolio is up 9.9%. I'm going to say it's been at least 15 years since I've made that statement. Longer term results obviously still reflect just how low interest rates have been for so long. So a couple things just to note from a change standpoint, and then I just want to spend a minute on the Edgewood portfolio. So the other pieces that we've had from a diversification standpoint, so if we fast forward to a conversation early next year where we're looking at a 1231 book, you're going to see Capital Dynamics added to this from a private equity secondary standpoint. That commitment was accepted a couple months ago, and we had the first capital call come in October. And then Bloomfield Capital, the real estate debt lender, called about 60% of our commitment in October, and we expect probably by the end of the year, maybe into January, for the remainder of that to be called and put to work. So they're seeing more transaction volume and more, as they put it, higher quality, higher yielding deals and opportunities than they've seen in a very, very long time. So I think as you've seen rates come back a little bit from a longer term standpoint, you are starting to see some signs of life out of commercial real estate. If we're looking at the DB portfolio, for example, the principal enhanced property fund there is actually flat for the quarter. So it seems odd to be excited about a a barely positive return out of real estate, but considering what we've gone through for the last 18 months, it's nice to see that turn. So you will see that change. The other two pieces that we're working on scheduling a couple of review meetings, but as candidates for replacement for Oakmark, given their continued underperformance, and the JP Morgan Emerging Markets portfolio. So that's something that we're working with Michael on offline, just to interview some other options in that space to look for an opportunity to improve the portfolio. So with respect to everything from a overall retiree healthcare standpoint, as I'd mentioned, it's good news, but not great news. That's the extent of prepared comments on this. I did want to take just a minute and touch on the other handout that I passed out on Edgewood, but I want to allow time for questions.
Any questions from the committee?
Yeah, so the two new funds that we're going to be adding to by the end of the quarter, where's that money coming from?
From the domestic equity portfolio. I realize it's a very generic answer. What we do when the capital calls come in is we take a look at
most of them are coming from Baird.
Oh, sorry, yeah, it came from Baird. Yep. Remember, because the premise here is pulling back from the fixed income exposure because we have a very, very long runway for the use of these assets. So fixed income is not really needed.
Perfect.
So in the Edgewood piece, there's just a couple things I wanted to talk about. So, large cap growth has been an immensely frustrating space for investors because the index has been nearly impossible to beat. And that's because of the level of concentration. So the Edgewood growth portfolio, if you take a look on page 1 here, you see the red arrow. So at the end of the quarter, Edgewood had 24 names in the portfolio. So you look at that and say, well, it's pretty concentrated, right? 24 stocks is a very, very concentrated portfolio. If you see right below it, you'll see a number that says 55.16. So the top 10 holdings for Edgewood represent 55% of their overall portfolio. Take a look over on the far right-hand column. The Russell 1000 Growth Index doesn't have 1,000 names. It actually has 394 names in it. But the top 10 names in that index represent 59.6%. That's how concentrated it is in Apple, Microsoft, NVIDIA, Tesla. So this is the first step I look at and say, wow, I think a 20 stock portfolio is relatively concentrated. The next step is we look to, well, what's in the top 10 holdings? And I would argue that Edgewood is less concentrated in a top holding position than the Russell 1000 Growth. Take a look at page 3. So page 3 is results as of 9/30 of 2024. And you'll look, for example, in the last year, they're up 35.2%. Hard to complain about saying a portfolio is up 35%, but their benchmark was up 42% for that same time period. So seeing underperformance. The biggest measure of underperformance is in that 3-year column. You see they're in negative territory in the last 3 years versus their benchmark up 12. What is interesting to me is they rank in the 94th percentile. So, down 0.2 versus benchmark up 12. And in the universe, there's 6% of the managers in that universe actually did worse during that time period. 94% did better because Wall Street has to keep things complicated. From a ranking standpoint, lower is better. Right, you want your child in the 90th percentile. You don't want your child in the 10th percentile. You want your investment portfolio in the 10th percentile, not in the 90th. So think lower is better. Well, let's go back in time a little bit. So if you take a look at page 4, so each of these rows on page 4 represents trailing returns as of 9/30 of 24, 23, 22, and 21. So we just go back a year in time. Well, if you take a look in what I have in the red boxes up top, so as I'd mentioned, in the last year, they're up 35%, benchmark's up 42. But in the last 2 years, they're actually almost in line. They're up 33.4, benchmark's up 34.7, and they actually ranked in the 39th percentile. So in the last 2 years, I would say they've actually fared pretty well against a benchmark that's been very difficult to beat and against a peer group as well. But that 3-year number, obviously you see the impact of calendar year 22, where they're in negative territory versus the benchmark that's up 12. And if you go out in the far right-hand column, right, we always say, hey, we're long-term investors, look to the long term. In the last 10 years, they're up 14.3%, benchmark's up 16.5%, and they rank in the 43rd percentile. So I would call that decent versus benchmark, decent versus peers. What's interesting is, if you drop down to the third row down, so you'll see it says as of 9/30 of 22, look at that 1-year number. Down 44% versus benchmark down 22.6. That 12-month period is what's causing, for most recent, right, the what have you done for me lately, that 1-year period back in 22 is the reason why their current 3-year number looks bad, 4-year, 5-year, everything as you look out. So why are they in the portfolio? Well, it's because prior to that bad year in calendar year 22, go to the very bottom line, as of 9/30 of 2021, and they were added to the portfolio back in 2020, but every one of those columns is in line or ahead of benchmark and well ahead of peers. So absent one difficult year in 22, when we saw a significant rise in interest rates, their track record, we think, warrants them being in the portfolio. Final piece I'll leave you with, you go to page 7. And pretty fancy charts and graphs. But what I think is more relevant is the comments in the titles to the right. So in the top half of page 7, what we have here is rolling 5-year returns. So it's the 5-year period ended 9/30 of 24, ended June 30 of 24, March 30 of 24, December of 23. So you add a quarter and drop a quarter. So you have 55 observations. So this is measuring the overall track record for the Edgewood Fund. On a rolling 5-year basis, they beat the benchmark 56% of the time. They lag the benchmark 44% of the time. But when we go to the bottom here, which is 10-year windows, that ratio moves pretty close to a 70-30 proposition. And when they underperform has actually been really as of late because of that difficult year in 22. But it's the instance where it's like, hey, we made you 15%, we didn't make you 18%. Or we made you 17% and we didn't make you 20%. So we continue to think patience is warranted here. And don't think shifting this to passive is the right move. Questions?
When you say passive, meaning Russell 1000 growth?
Yeah. The level of concentration there just scares the daylights out of me.
Meaning buying an index fund.
What's that?
Meaning buying an index fund.
Yeah, meaning saying, look, we want large cap growth exposure in the portfolio because those are names that should benefit from declining interest rates, should benefit from continued growing economy. So then the decision is, do we own it in an active fashion or a passive fashion? And the level of concentration in the index is deeply concerning to me to say this is something where we should have an active option from a risk control standpoint.
Okay. Any questions on Edgewood?
Again, just my comment would be is, you say to continue to always look long-term, right? If we take out a bad year, obviously, then they can look great.
Yeah.
But a bad year for us, again, since our inception, since we got them in 2020, we were lagging behind 8%.
Mm-hmm.
So again, when we talk about like the compounding interest effect and how much this affects our portfolio, that has dragged them down. And enough where we continue to not even meet the benchmark. I
Right.
understand what you're trying to showcase is that one bad year is what caused them to have the problem. And if we look bigger picture different ways, it'll just be hard for us to continue if they have another bad year, right? We don't know. We have to look always big picture. But they could have another bad year that continues to put them down. And then we would have lost that opportunity to move the money.
Yeah. There's
I'm
always
not a fan.
Yeah.
I'm just not a fan.
Yeah,
I understand where you're coming from.
Totally respect that opinion. I just look, one of the biggest struggles is, you'll see the study, like, hey, the average mutual fund has done say 9%, annualized over its track record. And the average investor gets 7. And why is that? And it's because they hire, great performer, I'm going to add them to the portfolio. They have a bad year, walk away, and I hire the next best performer, and you perpetuate that cycle. And that's really what we kind of seek to avoid. I will tell you, our research team has spent as much time with Edgewood as they have with Clarkston, in the last year. And the Clarkston guys can talk about it. They were in their office. It was either September 21st or 22nd. It was a Tuesday. Had an hour scheduled, and walked out of there 4.5 hours later. And Josue Christensen is the one that covers Edgewood, did the same thing with them, like sat in their offices and was like, we've got, an hour scheduled, and ended up spending 4, and walked out and was like, I think they're really, really good investors. It's just a very difficult market in large cap growth right now.
And again, you brought them in for the other meeting before where I got to sit in and talk to them. And again, I don't think that they're bad investors. It is just, we're going to be looking at getting rid of Oakmark, even though Oakmark had a great year this year. So it's not like we're saying, okay, they had a great year, we're going to give them another chance. We're saying over the time, we've noticed that they are not able to perform up to our level, and we're looking at replacing them.
Right.
Because they have continued to fail the benchmark of what we wanted, even though they had a great quarter this. So the same thing I'm trying to say is back to them is they had a bad quarter. They had a bad last quarter. They had a bad last year. They weren't able to meet. So why don't we consider replacing them? You're saying give me more time. I'm not trying to flip-flop. I'm just trying to say.
It's because flat out there's a higher conviction in the team at Edgewood and Clarkston than there is at the team at Oakmark. In our conversations, we walk away with a higher degree of conviction, walk away with high conviction in Clarkston and Edgewood, and walk away with, I don't know that we're going to see Oakmark recover. So that's a bit more of kind of the qualitative side of thing, right? Where they're walking away, and it's what was the passion in which you delivered your confidence in your portfolio, and we got it from Edgewood and Clarkston, and we didn't get it from Oakmark.
Okay. All right, so to summarize, we're staying positive on Edgewood, but we are looking to replace Oakmark and the JP Morgan Emerging Markets Fund. Brian's going to present some candidates for replacement sometime in the next quarter, and we'll review those. The other thing under new investments, just to highlight what Brian said, that our investments in Bloomfield Capital and Capital Dynamics, we've begun making contributions. They've called our capital, so we'll start to see those as lines in the portfolio at our next quarterly meeting. Which leads me to our next quarterly meeting, Wednesday, February 5th, 2025, if you can believe it, 7:30 a.m. in this room.
Is there some meeting there to 2/5/25 that we have to?
I don't know. 2/5/25. Are there any other comments or questions? All right, then I'll say we're adjourned.